Don't want a pink dot. Okay, Schedule A is for when you want to itemize your deductions. So what we did last time, they had their medical and dental expenses, but we determined that it wasn't high enough, so they couldn't claim any of those. And then they had their state income tax, real estate taxes, that gave them $6,865. Then they had their mortgage interest, which gave them $3,096 that they could deduct. They had charitable contributions, which gave them another $14. They had that loss. I come back to it. Right here they had flood damage. So that's a casualty or theft loss. So that goes here. And then we had some employment expenses, job travel, and union dues, and tuition. Schedule A. So that added up to $42.95. And then we did the formula to see how much it has to be over this amount. And since it's $42.95 and $42.95 is over $15.40, we subtract to get how much you're allowed to actually deduct. Then you add up everything in this column. And this is the total of your deductions. Now, if this amount, okay, because they're married filing jointly, right? That's the standard deduction. If this amount is greater than the standard deduction, you take the itemized deduction. If the itemized deductions are less than the standard deduction, then take the standard deduction. You take whichever one's larger. And in this case, the itemized deductions are larger, so they would take their itemized deductions. And sometimes you have to actually go through all the work and figure it out before you know if it's going to be larger or not. Sometimes you can look at it and go, wow, yeah, no, that's not going to work, and just not have to do the work. It just sort of depends. So their itemized deductions are $23,383. They get to take this out of their taxable pay, taxable income. That's why you do this, because that now reduced their taxable income by $23,000. So I'm gonna cheat, pull up the calculator, because I don't feel like doing this the long way. That brought them down to $56.29. Whoops, $53,629. Okay. Now they have exemptions. Do you remember how many kids they had? Do they have kids? So let's look. They have one kid, so they have 3 exemptions. So we're going to do that 3,800 by 3 again. Hold on. Exemptions. So that goes here. And we subtract that again. So I'm just going to kind of do it backwards, but which brings them down to $42,229. Okay, so if you look at that, itemizing their deductions and taking their exemptions brought them down from $77,000 to $42,000 in income. So now we have to find their tax on $42,000. So we go to our handy dandy tax table. And we're in the $42,000. It's 229, so that's going to be between 200 and 250. They're married filing jointly, so 5,464 is their tax. Okay, that's their tax. Alternative minimum tax, we're not going to really deal with all of that. There's things that'll qualify you for that you get a different tax rate than other people.
Ms. Hayden,
Yeah.
was the tax from line 43?
Yes. Yeah, from line 43. Okay. So we don't have an alternative minimum tax. You'd add lines 44 and 45. So we're going to do 5464. That's their tax. Okay. Now let's look at the problem that they had again, like their problem with all their information. Oops, wrong one. Okay, so we've totalized. So we're going to finish completing their taxes. Oh, that's wrong. That should be 3,800. Okay, so they can get a tax credit for $780. That's in the problem. So we're going to go ahead and put that on their child and dependent care expenses. Okay, $780 because they pay for child care. And then they installed some energy saving items so they can get a $133 tax credit for that. And that comes under here, residential energy credits. Do you see that? That's relatively new that they've, you know, to try to get everybody to go green and increase energy efficiency and stuff. They've got these.
Changing light bulbs?
No, it's doing things like you can get tax credits for certain things like upgrading the insulation in your home, upgrading the windows to make them more energy efficient, upgrading certain appliances. There's all kinds of details about that, like what qualifies online, but just changing light bulbs unfortunately doesn't do it. It has to be major. And then it's not the full amount either. There's a formula. There's always a formula. Okay, so they get the $780 for the child care expenses, the $133 for upgrading their home. So that we total up. Oops, we total it up here. So they get $913 in tax credits. That gets subtracted from the $5,464. So deductions reduce your income. Tax credits reduce your tax. Okay, so let's do 5464 minus 913. This is their actual tax. Okay. Now, if they were self-employed, they'd have to do self-employment tax. You pay extra for being self-employed. If they had Social Security, tax on IRAs, household employment taxes, this is if you have employees that work for you or you work in somebody's home. First-time home buyer credit repayment, other taxes, you know, these are things that you may or may not have to deal with. If you don't have to deal with them, you just leave them blank. And then you add all that up. Well, since there was nothing to add, it was easy. Okay. Now we have to go back to the problem originally. Okay, and we've got to find, okay, they paid, where? Oh, I deleted the wrong page. Hold on. Let me pause this. Okay. Any questions about that?
Possible to get a refund like that?
Yeah. Yeah, it's just, it all depends on, like, okay, so things that might get you a refund that high, maybe you didn't pay in a whole heck of a lot of taxes, but maybe for your deductions, like what, I don't know, your house burned down. and you had no insurance. So your deductions are huge. You know, so then you would get all of your money back. Because if you had a, you know, $100,000 house or something, that would probably override your pay. So your taxable income would be zero. You know what I mean? Or if you have, you know, these tax credits, if you got every single tax credit, it could also bring up your tax, you know, make your tax zero, and you get everything back. Now deductions, if you have deductions equal to your income and it makes your income zero, you can only get back as much as you paid in. If you, they come out of your paycheck. So if your deductions are such that your income, your taxable income ends up being zero, you get back what you paid in. If your tax credits are greater than you pay, like you could end up paying in, like, let's say I paid, just to make numbers easy, maybe I paid in $1,000 in taxes, but my tax credits are $3,000. I'm going to get $3,000 even though I only paid in $1,000 because my credits can actually make my refund bigger than the amount I paid in. But deductions can't do that. Deductions can only lower your income. Tax credits lower your tax, and they can actually make it so that you get back more than you paid. That's what happens with a lot of people that are living below the poverty level. Don't pay in as much taxes, but if they have kids, they get the earned income credit, and so they actually get back more than they paid in. So that can happen.